Hi, good morning. Peter Rose, Longwood Currency Trading. I've got a cup of coffee and I've got the trading platform going and ready to go. It's a sort of a chilly and windy mid-September day in New England, and it was down to like 36 degrees Fahrenheit last night, so it got just a bit chilly. Today's video is, I'm calling it Questions in the Key of Forex and Other Sad Songs of Trading. Look, the topic is really geared toward that 21 to 34-year-old age group that I try to address in quite a few of the videos, because I think you're the folks that are going to pay attention to what I have to say. I haven't had much luck at my age. Look, I'm 71 years old. Nobody's as old as I am that's trading, but you know, the 50-year-olds and up who need this stuff the most, I don't know, they just, I wish that group would pay a little bit more attention to some of the things that I'm talking about, because it's not as daunting as trading as you would make it out to be based on the failures perhaps that you've had with past investments and all that other stuff, and all the scare, I don't know, what do you call them, news or whatever that you read about, or people that tell you how difficult trading is and how dangerous it is. Speaking of dangerous, I better move my camera over there a little bit so it doesn't fall off the desk. So the issues in the key of Forex. The key of Forex is that that underlying hum, that beat that the market has 24 hours a day, 5 days a week. That trading hum, the interaction of two markets, two countries, two currencies in the solution of their joint economic problems, the commerce that exists between them. That's the currency market. It's $6.6 trillion. It makes all the other financial markets combined look like a shit dust. So for safety's sake, it's a good market. And for liquidity, there is no market that is more liquid than the Forex market. And those two things are, and it's open 24 hours a day, 5 days a week, so that you don't get these huge gaps and spikes and all this craziness. What are you going to do? What are you going to do? You're going to go into the stock market. You're going to cowboy it out in the commodity market, make a lot of money in the commodity market, but there's certain characteristics of the commodity market that induce risk other than trading. Huge gaps, for example, that are fairly commonplace is a tough thing. What are you going to do? You're going to do stocks, you're going to do bonds, you're going to do, what are you going to do? You're going to pick between, I don't know, 6,000 stocks, you're going to go out and do your research. How exciting is that? I mean, there's a lot of folks that do that and they get cranked up about it. I happen to say I'd like to deal in markets that are going to be more predictable. You know, a company may come out tomorrow and say they missed their earnings estimate by 70%, and the stock falls apart, boom, just like shit through a goose, you're done. A country doesn't fall apart like that. It takes months, if not years, to atrophy. The situation in Britain with the Brexit thing, there was this huge bang spike, thousands of pips in a very short period of time. But you could see that coming, and once you saw the headlines and saw what was going on, you go, you know, maybe I'll go on the short side here, or maybe I'll very carefully trade that event. You have time in those instances in order to see those things that are going to be really, really big. And we have a really cool thing called a stop loss that you can put anywhere. If you don't like to have short stops, put what they call long call or panic stops or deep stops on your positions that are, let's say you're trading for profit targets like I am as a short-term scalper, 20 20 pips a day, 25 or 30 pips is what I need as a profit target. I'm happy with 3 pips, or I might take 8 pips or 13 or whatever it is. So, a deep stop to me might be 50 pips, or maybe, I don't know, whatever that is. And then I'll have my trading stops that are involved in that. But if the thing gets away from me, or for some reason there's a short lapse of liquidity, I can't imagine, because I don't trade it at, when the countries are both asleep. It's just and let other countries dictate what they think about those two particular currencies. No, I don't think so. There are ways that we can mitigate so many of the risks that are inherent in other markets. I guess the issue is fear of getting in. And once you get into these markets, then you're another kind of fear of missing out. Oh, I'm afraid I'm going to miss this trade, so I'm going to do an anticipatory, what I call an anticipatory trade. I'm going to get in ahead of time so that I can scrape the last few pips off the trade when it goes in my favor, and the thing turns around and everything goes to shit. So fear is a horrible thing, and it works against us. Look, I spent 50 years in the martial arts. I'm an expert in fear. I don't fear. As Pogo says, we've met the enemy and he is us. It's something you have to embrace, and you embrace it by understanding what's causing the fear. The fear is the fear of loss, right? Well, why, when you get into these markets, is it shown that most retail traders have such a fear of losing out that they get in too early, and then when the trade goes against us, they're so afraid of missing out on the opportunity that they let that trade just go badly against them and wipe their account out. If you can solve that problem, and that's not a market problem, that's a personal problem. If you could solve that problem about fear of terminating a bad trade, if you could solve that one problem, you could probably be a successful trader. And I've got a situation where, because of the parameters, the currency pair that I've got, and the times when I trade, I've got an 8 pip stop. And I get into a trade, and if it goes 8 pips against me, I get out. When I follow my rules, I get out. And you know what happens when I don't follow my rules? I just let the thing run, because I don't give a shit. Because right now I'm playing with too little amount of money. And when I did have a large account, I didn't have the grounding of the principles of trading. I didn't have that. I didn't have a mentor. I didn't have anybody to teach me this stuff. I was relying on the stuff that I was learning or studying in books and in videos was the straight scoop. And for the most part, it is the straight scoop. But it's not the straight scoop as to when you're supposed to do this stuff. That's the critical thing. And the thing that screwed me up is I had a 40-year career as a real estate investor and retired successfully after all that. And I was trying to map those trading skills into the currency market. Look, trading is trading, whether it's stocks, bonds, currencies, old tires, doesn't make any difference. It's trading, it's for sale. But there's certain nuances in each one of those different markets that you have to understand, that you have to know about. And I didn't figure that out until I'd lost all my money, gone to the wood with a $40,000 account. And I thought, what the hell is this? Oh, I get it. It's this difference here. And I took my remaining $5,000 in the account. I figured this out in 15 minutes. It sounds stupid. Why couldn't I figure it out before? Because the loss of the money made me stop and go, why did this happen? It wasn't just little losses that you accumulate yourself to over the long run, and you run your account down. It was like immediate. And so I stepped back and I looked at the situation. I said, I'm a pretty smart guy. What happened here? Why did this occur? 15 minutes, I figured it out. So I started to try to implement that very slowly over the course of the next couple of weeks to see if the process was valid, if it was correct, because it was non-intuitive. And I took that $5,000 account and almost, it was pretty close to double in 4 months. So you have to really look at the conditions of the market, not the conditions of price action, but the condition of the market itself. What kind of market is it? I mean, if you have a used car lot and you sell used cars, there's certain nuances to that market. It has nothing to do with cars. It's the market. It's used cars. And there's a psychology of the person that comes onto a used car lot that's different than the psychology of the person that comes onto the brand new car lot, right? And so if you're thinking about trading this stuff, you just have to find somebody that's going to give you these differences, because you're not going to find them in books and you're not going to find them in videos, because I'm a pretty smart guy and I looked for that stuff. I read lots and lots of books. If you look behind me here, all these books are trading books or finance books. So I kind of get an understanding of this stuff. I've got a degree in physics. You're pretty smart, okay? But I've got a lot of education and a lot of information behind me, and I've been through all this stuff. And what you're going to find in the books and the videos isn't going to provide you that answer. It isn't going to give you that important key. So if you're thinking about getting involved in the currency market, or you already are and you're not having the success that you think that you should, step back from the thing and quit looking at fucking price action and look at the market. What's the psychology that you need to have in order to participate in that market? If you're going to a funeral, you have to behave differently than if you're going to a bridal shower, okay? So you need to change the way that you think. I've been in martial arts, as I said, for 50 years, and my martial arts master, Sam Brock, told me back in, oh my God, I think it's probably 1969, the only way that you can change who you are into who you'd like to be is to alter the way that you think, because we're a product of the way that we think, and thoughts are things. And so the way that we think about the market and its risks and how we interact with those risks, if we think negatively about that, that's a thing. That thought becomes a thing, and it will impact us in a negative way. It'll impact our trading in a negative way. You're not going to eliminate those risks. Those risks are there. When you drive your car, you're not going to eliminate the risk of a car crash, but you mitigate it by driving carefully, following the rules, and wearing a seatbelt. I mean, come on. This stuff isn't rocket science. As an engineer, I tried to make it rockets. I made it more difficult than it was. I wrote thousands and thousands of lines of computer applications and studying this stuff, and then I tried to go and apply that in real time. Doesn't fucking work. Because I wrote the application to do the wrong thing. I'm writing a computer simulation application in currency trading right now. Starting to write one. But this is the right way to apply simulation to the market. And I'll learn something important. Well, I'm not going to learn anything because I've already figured it out. I'm using the simulation in order to find out the statistical likelihood of that being consistently extracted from the market, let's say. So there's ways of studying these markets, and there's other ways. You just can't read a book and have information and go out and start pushing bid ask. You can't do that because that's not sufficient. So step back from things, find somebody that knows about this kind of thing and that will share that with you, or figure it out for yourself. Not by trading, but figure it out for yourself by taking the things that I've just talked about and looking at your own life and looking at the markets that you want to trade and try to come to some conclusions as to what information you need to know. And then go back to the books that you like reading and start looking for the answer to that particular question in those books. Because if you don't have that particular question, how are you gonna pick that out of the books? Most of the authors don't even know this. They're good at what they do and they're successful, but they don't know how to break that process down in any other way than giving you patterns and indicators, and when the fast MA crosses the slow MA, and all this other stuff that it works, but it doesn't work because the indicator is correct. It works because the person has learned something about themselves and about the markets, and they're using the indicator simply as a confirmation that what they feel, what their gut, as Curtis Faith would say in his book, Gut Trading, I think that's what it's called. What's it called here? Oh, it's not in my list of hot topic books. It's back there. But anyway, Curtis Faith wrote a book on gut trading. Very, very interesting. You don't learn that stuff in a book. You gotta learn that information, and then you start experiencing it within the market context itself. Don't be fearful. Do this stuff, but do it smartly, because it can reward you so greatly. Look, I got out of real estate. I've sold off all my real estate now. I sold my last building this month, actually. And I'll use some of that money to refund my account, and then I can get down to some serious trading again, so screwing around like I have been for the last 6 months. Don't make your trading a sad song. Make your trading fun, because you have the information that you need in order to trade, what to do. You have the skills in order to know how to execute that. And you understand the psychology of the market and yourself, so that you know when you should apply some of that stuff. Peter Rose, Longwood Currency Trading. Have a great day. Have a great trading day.